All righty. Cool. Well, hey everyone. Thanks for joining us. Happy New Year. Thanks for coming and joining this to kick off 2021. So my name is Samantha Wong. I work at Apple. I'm in finance here. So I'm here kind of in part as a new real estate investor, partially a friend of Eng's, kind of. Well, you made me money, so I guess we're kind of friends. Anyway, I kind of wanted to just introduce this by giving a brief background on myself. So last year, I started discussing with my husband the possibility of diversifying our investments. So at that time, we were at 100% invested in stocks. And so we were talking about maybe going into a mix of stock and real estate, and for a few reasons, taxes actually being one of them, going into real estate. So we kind of started where I think most people start, looking at single family home rentals, largely locally, but the math just didn't really make sense for us to pull our money out of a bull market, just looking at single family homes here in California. So then we started exploring commercial real estate. We started literally just driving by, various retail locations all over South Bay. We'd see like a bulletin posting, we'd call the number, get their pro forma, kind of do some Excel on the side. And then we started asking our friends and family. And for us, actually, we didn't know anyone who had ever invested in commercial real estate. So that kind of gave us a little bit of a pause. We would start Googling, and even Google didn't give us that much information to feel very satisfactory. But then kind of serendipitously, then I heard Eng present at the Real Estate Investment Club last year. And so then I got coffee with him and, found him to be this just amazing resource of pretty much all things real estate, not just commercial, really everything. And I'm sure I sounded like a complete newbie, but Eng was nice enough to pretend that I wasn't. So we met up a few more times after that. I ended up investing in one of his deals, and here we are, maybe friends. So I'm still learning. For example, I know that there are, like I said in the beginning, I'm investing in real estate partially for the tax advantages, but I'm the last person to say that I'm an expert in it. So with that, I'll just shut up and let the expert talk. So Eng, take it away.
Thanks, Samantha. And it's nice to be our co-host today, really helping moderate. And if anyone has any questions, asking me, interrupting me. This is a lot of repeat information that I presented to many different audiences. So I'll get generally very bored of presenting the same stuff. But maybe for some of you guys, it's new. Hopefully it is. If it's not, I can make it new by asking me questions. And I think we're friends. We got durian together.
Yeah, that's true. We did. So I guess it does. Yeah. So everyone, feel free to put something in the chat box, the Q&A, or like Ang said, just pipe up. If it's in the chat or Q&A, I'll try to read through them all and bring them up too.
So today I'm going to talk about real estate and taxes, something that is near and dear to my heart. I love real estate, and I love not paying taxes as much as legally I can possibly can. And for those who don't know me, I used to work at Apple as of last year, and I left Apple after having enough financial freedom or passive income from all my real estate endeavors. And I've been investing in real estate since 2009. But my background is pretty varied. I went to Wharton, degree in economics, did investment banking, went to Peace Corps, did some analytics, and joined iPhone team, did Apple Music and Siri. And since then, I've also founded Tozy Capital, the company I'm working at, have these deals at, and we have 100 million of assets under management. So quite a bit of growth since I even met Samantha. And I'm always learning and growing every day. And hopefully you guys can learn a few things here. I want to say that I'm not a tax professional. I have paid a lot of taxes in the past. I hope to not pay those taxes in the future. Although I think because I am in California, I will probably still pay California taxes. California does not conform to a lot of these tips and tricks that I'll highlight. But I wanted to start with a segment on the Joe Biden tax plan, a little topical, and I had a few additional thoughts on it since last time I presented this. One of the things that really, if you think about what Biden has talked all along, he's talking about taxing the rich, taxing those who make incomes of $400,000 and above. So that's definitely potentially impactful for many of you guys in the audience here. But there'll be also additional credits and other stuff to potentially help some of the SOT limitations and whatnot. I'll go into a bit of what this could look like for you guys. The tax rate is going to continue to be more progressive. This is still probably, this is actually better than what it was before in terms of the taxation rate. And there's going to be a little bit higher bracket on the top end at the federal level. Of course, California is very different, probably paying 13.1% on that anyways. And then Social Security tax. So for those with W-2 incomes, like most of you guys, there's the FICA tax, and that's going to continue and grow above that, above 400K as well. That's the proposal that he has. He has some changes to deductions. One of the most important ones is the SALT deduction. That would likely happen if there was a Biden tax plan passed. That $10,000 state and local tax deduction a limitation has probably impacted a lot of you guys. For Samantha, who just bought a house, you can only deduct $10,000 worth of state and local taxes, including your property taxes. And so there are, you know, if you're buying houses in the Bay Area, I'm sure it's quite expensive. And so it was better before, basically. And now it's not as good in terms of the tax advantages of owning a house. But if that's eliminated, that could be very beneficial for most of you guys. And then there's a few other deductions I'm going to highlight here. Some tax credits that Biden's proposing, and a lot of it's around sort of providing child and tax credits. You know, I just had another kid, so 2 kids now. I was definitely doing for the tax credit, so $2,000 tax credit. And there's a first-time home buyer's credit. I'm not sure, Samantha, did you get a tax credit for your first home that you bought?
We're going to, I think. Yes.
Yes. So
first time home buyer in California. Yay.
Highly recommended, right?
Yes.
That's all that's cracked up to be. But that's something that could be very impactful as well. So that's like a brief overview of the tax plan. And of course, he doesn't have anything firm. This is actually just Oppo research that people have done based on what like a tax council has shown. But in general, I don't think Biden's tax plan will happen. If there would be, I presented this before when the election results did not come yesterday or this morning. And the Democrats do now have the Senate majority. Is a 50-50 edge with Vice President Kamala Harris breaking that tiebreaker. But if you guys remember, when Obama had a 60-vote majority, he only really passed Obamacare in 8 years. That was the only piece of major legislation, and he used a lot of political power to do that. I do not believe that Biden's going to use his political power which is going to be limited based on the 50-50 slim edge to pass any major tax law. Most laws do not get reverted in 3 to 4 years, which is what this would happen if it did. The stimulus is going to be the priority. Justice reform and green energy and healthcare would be second in line. I think those are what the upcoming president and administration will spend a lot of the political capital on. Tax reform is not a priority, and it won't likely be a priority for a while. And you still have a lot of red state Democrat senators that could filibuster anything or just make it a little bit harder to pass any of these things. So I think a lot of this is fear mongering a bit in terms of like people talking about 1031 exchange not happening anymore, or removing some of the most recent benefits of tax real estate investing. I think that's not going to happen. If you follow the power, you follow self-interest, you will probably do the right thing most of the time. If you align your interests with people who invest in real estate, which is almost every member of Congress, they're probably not going to, harm themselves. They're not going to do self-harm to themselves in general. Obviously, Congress is not logical all the time. So CFOs generally agree. They don't think that Biden will raise the corporate tax rate to 28%. That's just one component of it. But that's just sort of saying that it's likely unlikely to happen in 2021, this year, and it will unlikely happen during this administration as well. That's my bet on it. Of course, could change. So I want to go into sort of the bulk of the presentation, how to pay less taxes. And so for some of you guys who have seen this, I've added a few additional things to it. Really what we're talking about is how to keep more of your earnings. So for those who file your taxes now, it's not something that you think about because you already gave up your taxes. You already paid taxes. You were withheld your income. But for those who can proactively look at using real estate to keep more of your earnings, I think that's something that you should look at. And I want to highlight how that works. When it's about taxes, it's about the facts. You have to rearrange the facts. So I like to think about this as an order of operations. When you get paid, you pay taxes on your income, and then you spend money. So you usually spend money on consumption with after-tax money. That's typically what happens for employees. For businesses like Apple, they earn revenue, they spend on expenses like salaries and R&D, and then they pay taxes on net profits. Of course, they try to report as few net profits as possible and have holding companies to shelter some of that. Something that you guys could apply a little bit. It's a bit harder to do if you're just a W employee. So most of us as employees are really trying to shift our facts of spending money from post-tax to pre-tax. That's a lot of our general tax strategy that probably we've been advised to do. 401k, for example, is about investing money pre-tax and essentially reducing your AGI by the investment amount. And because you reduce your AGI, that top end marginal tax rate, you're essentially saving that taxes. Or having HSA or FSA or any of these other healthcare strategies that really about having the ability to spend the money you earn in a pre-tax situation. So most of our tax strategy is about shifting our spending before paying taxes. So employee, get paid, pay taxes, spend money. Businesses, a little bit better, get paid, spend money, and then pay taxes. And I like to think that investors, hopefully all you guys are trying to become investors, you spend money or invest, you get paid, earn cash flow, hopefully, and then you pay taxes on that. But let's talk about how to not do that. So one of the things that real estate is primarily known for is a deferral of taxes. That's really a lot about what real estate investing strategy is. It's deferring taxes, capital gains, depreciation, cash flow, and having the ability to invest tax-free income, tax-free cash flow, tax-free capital gains, and grow your wealth, and then potentially pay taxes much later, or not at all. So I wanted to highlight 3 things about deferrals and talk about them at length a little bit. Depreciation, which I'll talk at length, and then highlight 1031 exchanges and opportunity zones in brief. Deferrals, I just want to highlight that deferring taxes or deferring anything is a really good thing. If you can pay something in the future, that's great. If you can pay something in the future and then invest what you didn't pay now, that's even better. So having the ability to defer taxes For example, in this case, if you owed $100,000 of taxes and then had to pay that in 10 years, you pay $100,000 in tax in 10 years, but your $100,000 you could invest in something that potentially generates 12%, like some of our investments, and compound it and reinvest it and generate $310,000 in total gains in 10 years, and then pay $100,000. So opportunity cost is something that people don't think about a lot, and hopefully that's something that you guys think about when you consider buying a house or doing anything with money. Think about the opportunity costs. Obviously, buying a house is very emotional.
I feel like that was pointed at me, but it's okay. I'll let that pass.
I bought 3 houses, and I bought this house a few months ago. So I am not one to judge. I definitely have had several tens of thousands of dollars of pool bills and replacement furniture and whatnot. Yeah. So when you are able to defer taxes, you're actually able to hopefully compound it. But think about how much you could have saved based on how much taxes you paid. You're actually transforming it as well. With depreciation, you're transforming it from ordinary income, typically paid at top marginal tax rate. So for example, 37%. And then and for depreciation, it typically does have a recapture. If you sell at the end, it transforms and then it caps at 25%. So you're transforming something that would have cost 37% to 25%. So already that's another benefit of depreciation deferral specifically. And inflation is another thing that people should consider. With an average inflation of 2%, which actually is very conservative, should probably be more like 3%, especially with quantitative easing and the Fed injecting tons of liquidity in the market. The money that you owe now, if it's the same absolute dollar, actually gets cheaper in the future. This is one of the reasons why I love long-term debt. I love getting 30-year notes and not fixed 30-year fixed, but 30-year mortgages, because if I owe something now and I owe it 30 years in the future, that the dollar just generally degrades over time. That's just what happens, not just with inflation, but also asset inflation as well. So I love having long-term debt because it's just cheaper to pay it as the dollar loses value, and that what you owe doesn't get adjusted for inflation. So depreciation is a really cool thing. It really allows you to get potentially tax-free cash flow. For example, if you invest $100,000, got 12% cash flow, 12% cash in cash. Typically, you would have, depending on the investment, enough straight line depreciation to offset all the taxable income, right? That $12,000 is essentially a net profit. What depreciation is an expense. You have expenses like repairs and maintenance potentially, or taxes and interest and other real estate costs that you might have not thought about. But in the example of, those are actual costs that actually comes out of pocket. So your net income potentially, if it's 12% cash to cash, if you calculate it right, you would potentially have to pay taxes on it. But for real estate, you get to use that depreciation and allow you to get potentially zero taxable income. So for my 12 years of real estate investing, I've probably paid 4% on my entire income of real estate. It's very nice. I probably could have paid less if I knew some of these things earlier. So that'll be. Another really great way to do this is do cost seg and bonus depreciation. And by the way, you can do this for your own property that's rental income property that you bought a while ago. Essentially, it's taking parts of the building and saying that instead of depreciating at a 27.5-year schedule, it's going to go all at once in 1 year. That's only parts of it. So I'm showing this real life example of an investment that actually Samantha invested in, where we did a cost seg study. But without the cost seg study, we would have taken $549,000 worth of depreciation. So paper losses in the first 5 years. With a bonus depreciation cost seg study done, we were able to take $1.5 million of losses the first 5 years. And of course, think about net present value and federal tax rates. This is a significant cash benefit. Essentially, you want to accumulate losses. And for those who can't use those losses for other passive income, you essentially get to carry that forward indefinitely. So ideally, you're just showing a negative number almost every year that essentially allowing you to pay zero taxes on the real cash flow that you do get. Hopefully, you're not actually getting a negative number in your actual bank account. You're getting actual cash flow, but this paper loss helps mitigate that. So when you invest in something like that, it's pretty easy to get, invest in like a syndication, for example, you get 12% cash in cash. Most syndications will give you around 50 to 60% of the cost basis of your investment as a depreciation benefit. This is pretty standard and even works better in certain asset classes, certain geographic locations. And so this gives you essentially a taxable income of negative $48,000 in the first year. And going forward, because you pulled some of that early, this taxable income becomes still negative. And so you don't really pay taxes on the 12%, which if you think about, you get 12% tax-free, that's similar to essentially getting 17% on your money. So it's a really cool way to think about investing in something, getting cash tax-free or really tax-deferred, and hopefully reinvesting that into other investments. So depreciation is a really cool thing. I think there's a few things to think about when you think about depreciation. When you buy with lower leverage, and I think sometimes people think lower leverage is good, and sometimes you have to buy with low leverage because the property does not generate much income. But if it generates a lot of income, you can actually get higher leverage. So with lower leverage, it actually degrades the value of your depreciation. If you think about it, if you buy something for $1 million and you were able to depreciate 80% of it because 20% of it is land value, you don't depreciate land, that 80%, the $800,000 of depreciation gets straight lined over 27 and a half years. If you borrowed 75% of it, you essentially put $250K to get $800K worth of depreciation benefits. If you borrow only 50% of it, you put $500K to get the same $800K of depreciation benefit. The bank does not share in depreciation benefits, so you get the full amount. So higher leverage, more depreciation benefit. A lower leverage, less. If you want to buy all cash, that is one solution to facilitate fast closes and potentially a discount, but you should consider getting a cash out refi pretty quickly. Another thing that I like to point out, and I don't think people think about when buying in California, land value is very high. Land does not depreciate. If you buy in high land value places, it reduces the depreciable asset. You're still paying the same amount of money. It's just the percentage of land value goes higher. In San Francisco, it can be as high as 50%. So all of this to say that this is why I try to optimize for this as much as possible. If I can invest in low land value places, like Kansas City, which is what I do, and I invest in high cash flow and potentially get 80% leverage, I can get an outsized depreciation benefit. That $12,000 cash flow now nets me a negative $5,000 a year in paper losses as well, which I could use on all my other real estate or passive income. So that allows me, or just carry forward and take that benefit potentially. So what can you depreciate? You can depreciate buildings that have rental income. If you are house hacking or have an ADU, you can depreciate that. You can buy a Tesla or any car that's 6,000 pounds and above and take 100% bonus depreciation on that. You can also buy a jet. I had a conversation today about that, and apparently it's all about depreciation. patents, IP, and software. Apple takes depreciation and all that. You cannot depreciate personal property, land, collectibles, or stocks. You cannot depreciate the house you live in unless you use part of that for rent or income. It's gonna be a little bit trickier, but you can definitely do that. So depreciation is really a deferral of taxes. I'll pause there and let Samantha maybe ask any questions.
Yes, actually, that's good. We've got two questions in the chat right now. We can go with that. So the first question is, should we keep a chart like this to understand depreciation? Should Schedule E have the value that you are claiming depreciation claimed?
You should always keep track of depreciation, because whether you take depreciation benefits or not, when you sell, the government will assume that you did. And they'll assume you did it at the straight line depreciation schedule. So if you're not taking depreciation and you have rental income or rental producing properties, you should fire your CPA or get a better software. It doesn't matter if you actually take the benefit. The government will actually assume you did, so you might as well take it.
Got it. Okay. And actually, I have a follow-up on that one for accountants. Would you recommend just sort of, because I've talked to a few people, not everyone has accountants, and so we were kind of looking for one too. Would you recommend like a real estate specific accountant, or do you think that this sort of information is one that most general accountants should know as well?
Depreciation is pretty standard. It should be understood by most accountants. I think getting a CPA is a very personal decision. Ideally, you're using a CPA to do future tax planning around a year of taxes, not doing it just for your April taxes. That's really the value of a CPA. I probably have talked to 40 CPAs at this point, and I think I know more than most of them, but I also need them to execute on the vision. But my taxes are very complicated. I have a lot of property. I have a lot of different things. I sometimes aren't aware of all the rules, safe harbor and all these other things. But I think, if you own property, if you own maybe one or two properties, I don't know if it makes sense to have a CPA. I think it makes sense to know taxes, know some of the tips and tricks, and but most software should be able to do it as well.
Got it. Okay. And then we have one more question, which is, what are the pros and cons of commercial real estate versus residential real estate?
Wish I had that slide. I had the slide doesn't sound commercial real estate.
And I feel like I remember you showing this to me the first time that we had coffee too.
So let's do some definitions. Commercial real estate is can be defined many different ways. I think most of you guys potentially thinking about it as, hey, it's an office building, it's a retail shopping center, it's a mall. It's something that's not residential. It's not like where people live. But it can be also defined as anything 5 units and above, multifamily, 100-unit multifamily, 426-unit multifamily, stuff like that. Those are all classified as commercial as well from a financing banking side. The pros of commercial real estate from that perspective is that the value of the commercial real estate is dictated by the NOI, net operating income. There's a commonly known trading point of cap rate. If you buy multifamily in Kansas City, it could trade around 5.5 cap. If you buy it in San Francisco, it could trade around 3.5. So you take NOI, apply the cap rate, and then you get the value of the property. For residential, if your neighbors sell for $1 million and your house generates $2,000 in monthly income, and he generates $1,000 monthly income, it's not like your property's worth twice as much. Your property's worth $1 million because he just sold for $1 million. If your properties are very similar, that's not the case with commercial real estate. Could have two kind of similar properties, and one generates twice as much income, and that's going to make it twice as valuable. So that's one of the pros and cons. It's more controllable. Obviously, you're not. That means that if there's market appreciation, residential real estate does have a little bit better correlation to that. And also residential real estate, just typically the loans are much more terrible to do. You gotta take a lot of explaining to figure out what is RSU is and RSU schedule. I'm sure you went through that, Samantha.
Oh my gosh, so much paperwork.
So I want to just keep continuing unless there's any more questions. No. Okay. So I talk about all these deferral tactics: defer, essentially keep pushing it back to the future, which has lots of benefits around inflation, compounding interest, and then actually changing the tax rate itself. So another way to defer, essentially, when you sell property, and this is for rental income producing property. If you sold a house, for example, or if you move houses, and now you're renting your previous house, it becomes a rental producing property. And then if it creates a lot of capital gains when you sell, you can identify 3 replacement properties within 45 days, and within 180 days, close on those properties, essentially defer the new capital gains that you've incurred, and also get more depreciation. So one of the things that I really enjoy is keep deferring. So when you invest in real estate, you cash flow, you take depreciation, and then you tender exchange the next thing. So you defer the capital gains and the depreciation recapture. So you don't actually pay any of that into the future. You can keep doing this indefinitely. And that's what I call the tender exchange cycle. You invest, you cash flow, hopefully you cash flowing. And the cash flow is important because if you don't have any cash flow, then you don't really have anything to offset. And so you're just collecting losses and losses and losses. And you get it when you sell, and you don't get the net present value and the compound interest and all the benefits of cash flow. So look for cash flow, probably not in California. And when you do this enough times, or not enough times, but you just do this, and when you pass away, the fair market value of the property just adjusted to where it is market value, and all the taxes that you have owed if you actually ever sold it gets eliminated. So your heirs now have essentially property that they inherited at its fair market value. For example, you could have bought something for $1 million. 7 years later, bought something for $2 million, tender exchange into it. 4 million, 7 years later, 20 million in 40 years, whatever it is total. And then your cost basis could be at zero, meaning that you've owed $40 million of taxes and you depreciate so much and you haven't paid taxes. But you also have a $40 million asset generating nearly $100,000 a month, probably more. When you pass away, now that fair market value, the cost basis goes up to 40 million, and you don't pay any taxes. So another.
We have a question on 1031. So if you invest the cash and then do a 1031 exchange with the, do you have the burden of keeping everything separate, or can the 1031 exchanged money eventually be pulled out to be used on other investments?
So what you're referring to is putting tender exchange money from a sale of real estate, and then putting potentially additional cash because you need additional cash to bridge any gaps on that property. That's pretty common. When you do that, that cash goes into it and kicks up the cost basis. That the depreciation that you've taken, essentially, and the capital gains gets deferred, and that you're taking the cost basis of the original thing, but you're also adding that extra cash value, so that cost basis goes up. It then cannot necessarily be separated out into the next investment after that. So I don't think you can. Another thing that I want to highlight is opportunity zones. So hopefully you guys are all familiar with it, but essentially, this backstory here is Sean Parker, ex-president of Facebook. He paid like around $1 million, and I think the whole group paid around $16 million to lobby Congress in the 2017 tax law to apply this opportunity zone law. And it was a bipartisan effort, which means I don't think it would change too much in the next administration, actually introduced by Senator Cory Booker. There's a lot of benefits here, and hopefully you guys are taking advantage of it if you guys are selling any stocks. it's a really little known tax code for Silicon Valley's really Silicon Valley people. Look what $1 billion can do to you. Opportunity zones, they're all over the place. Actually in San Francisco as well. I mean San Jose. So it's not really just in the most impoverished areas, especially downtown San Jose near the new Google development. There are opportunity zones. I wouldn't necessarily invest in California, but there are opportunity zones in California. And there's 3 major benefits of investing in opportunity zones. One, if you sold $200,000 worth of Apple stock and your cost basis is $100,000, you would pay 100 taxes on that $100,000 of capital gains. If you invest $100,000 capital gains into an opportunity zone, you get to defer those taxes that you would have owed up until 2027, at which point, early 2027, at which point it gets reduced by 10%. So you owe it in the future less. So remember, we talked about deferral, opportunity costs, and then actually transforming. And then if you hold the opportunity zone for 10 years investment, all future capital gains gets eliminated. Not necessarily the one that you owed in the past that you do get to pay that eventually in 2027. But for the future capital gains, it does get limited. What's eligible here is short-term and long-term, sell business and sell real estate. So really some great benefits, especially for those who have incurred a loss of capital gains. It's just, if you think about it, it's like a discount on your investment. You get a 20% discount on your investment or a 37% discount on your investment. The investment has to suck a lot to lose that advantage. But still, obviously, you should think about it as it needs to be a good investment. Don't just invest in something just for the tax reasons. Although, obviously, real estate investors invest because it's tax advantage and the yields are much better than the average market. I'll pause there for some questions.
Yes, we've got a few. So the first one is back on depreciation. So how does depreciation recapture work? And how does it work if we take home partial boot after 1031 exchange?
I'm not sure what you mean by partial boot, but depreciation recapture works essentially if you took $100 worth of depreciation benefit in 7 years, that $100 becomes a capital gain at this point because it actually reduces your cost basis. So if you bought something for $1 million and you take $100 of depreciation benefit, that means you depreciate the cost basis to $900,000. So you took it down by $100. So you're, and so then you sell it long-term capital gains rate, but it's capped at 25%. So you're transferring into long-term capital gains at 25%. You essentially reducing the cost basis because if you sold it for 1.3 million, for example, and depreciation didn't exist, which it does, and it will be automatically applied even if you use it or not. Your cost is would be $1 million, and you'd have to pay capital gains on the 300,000. In this case, you pay capital gains on the net of your sale and your cost basis and all the other expenses that you can add into it.
Okay, and then we've got one on QOZs. So what happens with the 10% cost basis increase if a QOZ refinances on year 2 and distributes back 50% to the investors?
So that doesn't have any impact on that cost basis because a refinance doesn't materially impact any costs. It's more of a shuffling of capital. So there's really no impact on refinances. Refinancing is actually a really great way to take out tax-free money. It's just essentially just shifting equity that is unlevered and becoming more levered.
Okay, and then continuing on QOZs, how do you see opportunity zone deals playing out in 2021 in terms of timing? Many of us will probably want to plan out our Apple stock sales as close to 2021 QOZ deals so that they're not too rushed within the 180-day window.
So with the CARES Act of 2020, there was an extension of that window that passed this year, really. So typically you do have 180 days from your sale of capital gains, unless you're selling it within an LLC. which most of you guys aren't holding your stocks in LLCs anyways. But if you're selling it, your stocks, your Apple stocks, you have 180 days to deploy it in the opportunity zone. And 2021 is the last year of that 10% benefit. Because if you invested in 2022, it now becomes only 4 years of benefit of holding that if you that essentially you have to pay at the end of 2026. You don't actually have to pay at the end of 2026. That's just the timeline that you essentially have to pay on your 2027 tax form. Now, the IRS shifts things all the time. Option zones have been evolving, and they evolved ever since it was released in late 2017. I would expect it to evolve a little bit more as well. The latest stimulus plan will probably evolve it a little bit more. And the IRS has resolutions that could affect things. I'm always trying to figure out what those are. But in general, they're trying to ensure investments happen. And that's why they allow those extensions to happen. But if I was looking at opportunity zones, 2021 would probably be the last year of this really great 10% reduction benefit. If the IRS code holds true, which as I say is evolving, but let's just assume that what it is will be. So you can still invest in 2022. It's just not gonna be as impactful. You only have a 4-year deferral now, but that 10-year benefit actually goes all the way to 2041. So you actually can invest potentially even up to 2027. Don't get any capital gains benefit, but you get the tax-free reinvestment benefit, which for most people who invest in real estate, you can just enter an exchange, so it's not that impactful.
Okay, and then continuing on OZs, if I invest in an opportunity zone fund today and hold until 2017, will my capital gain rate be 5%, assuming a 15% was the cap gain rate on the year stocks were sold?
So it's not, I'm not.
Oh, 2027, sorry.
I've had this question asked. Essentially, you're asking, will my capital gain be at 5%? So no, it's not a 10-point reduction. It's a 10-point increase in your cost basis. So if you owed, if you had a cost basis of $100,000 and you sold it for $200,000, your cost basis goes up by 10%, thereby reducing your capital gains by 10%. So now your cost basis is $110,000 and you owe taxes on $90,000. Hopefully that's clear.
Got it. Okay, and then we have 2 last questions before we move on. These aren't on OZs. The first one is, what's the tax implications from converting a rental property into a primary home, assuming cost segregation in the rental?
Assuming cost segregation in the rental? Well, let's do the tax implication. There's no tax implication of converting a rental property into a primary home. You could rent something, do cost seg, and then convert it to primary home. That depreciation just gets stalled and trapped. I would probably consult with CPA at this point because now I'm a little bit out of my depth because I have done this a few times, but what I've seen is people, your depreciation gets stalled and trapped and essentially frozen. And then when you convert it back into rental income, it just resumes. But I would ask this to be.
Okay, and the last one before we move on is, as a new real estate investor like myself, what cities should I be looking at? And would you recommend single family versus multifamily for newbie investors? We could push this in the end if you want to, or continue on. And
No, that's fine. So I think it really depends on your goals. I would try to figure out what your own goals are of, I think when most people invest in real estate, they're looking to get cash flow, rent. It's a clear understanding of how real estate investing works. I would question then why you want to buy your own properties if you want to buy single family or multifamily triplex. And I did start buying triplexes and quadplex early on in my career, but that's all I knew. think about if you really enjoy that, think about wanting to do that multiple times. If you like buying single family and you think you can buy 10 in the next 10 years, that would be a probably good use of your time, just learning how to do it again and again. In terms of market location, most people definitely think investing in the backyard is a good idea. I think most of us are in the Bay Area. Actually, I'm not anymore. But that probably means it's not such a good idea because the cash flow is not there, and there's no cash flow, there's negative cash flow. And you're likely be really more subject to market volatility. I would not invest in the Bay Area for real estate investing purposes. If you're wanting the benefit of investing in the Bay Area is investing in real estate is great. But you're losing money every month because you're spending money of your own pocket to pay the mortgage and maybe even have to manage it a little bit. If you have a property manager, you still have to manage it. And it appreciates, hopefully, and it has for the last 10 years. And it's appreciating at a leverage rate. That's really the big benefit. You're essentially leveraging depreciation. Any 10%, if it goes up by 10%, and is 80% leverage, that means you put 20%, that you have 20% of equity, that grows to 30%. You think about that math, essentially growing your equity goes up by 50%. So that's a really powerful thing. That's why I love real estate leverage. But if you're buying it unlevered, then buying Bay Area stocks is a much better way because most of these places and the value of their homes, single family specifically, is tied directly to affordability. If people can afford more, if Apple stock is going higher, then people can afford to pay $3 to $4 million in Cupertino. If it wasn't happening, then I don't think the trends we've seen would have happened. And then financing gets cheaper as well. That means people can afford more. So those typically are the trends why single family moves up and down. I didn't answer your question specifically because there's a lot of depends. In general, I would probably advise not to do that, but there's a lot of other ways to think about how to invest in real estate. In fact, I should probably just do a webinar on that and stuff. I'll start. I have a few more slides. I'm just end it. So I talked a lot about rearranging facts, mostly around deferrals and shifting from now to later. There's a lot of other ways you can do it as well. One thing people do is potentially rent the places as Airbnb. If you rent your place as Airbnb, it's actually an active income and then you pay hotel taxes a little bit. If you rented your property to a LLC that you own, and that LLC then rents it to an Airbnb that you own, that you set up, you're essentially shifting your active income because you're netting it out at that entity level. You're taking active income to passive income, and then you're making that, and then you're making it a little more tax favorable. Long-term versus short-term is another way to, most people, short-term capital gains is active versus long-term is passive. Pay your kids. These kids right here, this same kid, but imagine I have two kids. $12,000 is a magic number. Pay them $12,000. Your AGI gets reduced by $12,000. It's probably easier to do when you're a sole proprietor, but a lot of us can be. If you're a real estate professional or a real estate investor, essentially that's owning a business. Shift consumption to expense. This is a bit harder to do. Obviously, a lot of people work from home. But if you're making money on the side, which is a bit hard to do in Apple. But if you're doing it with real estate, it's like a business. So you can keep thinking about how to reduce your income by shifting things. Another thing people do, and I have done, is shifting my passive income to active income. So I talked about shifting active to passive. Why would I want to shift passive to active? Because I just talked about all these ways to generate so many losses, so much depreciation losses. It's going to be so good. What if you can't use it? But imagine if you could use it against your active income. And this is a flow chart of how you could do it. Google it. I don't want to go into it, but essentially most of you guys can't do it. But if you have a spouse that isn't working and has an interest in real estate, and can put 750 hours into qualified real estate activities, and you're filing jointly, then it could make sense, because now all your losses, your passive losses, become active losses. And whether you like him or not, probably most don't, and it's a little, off key today. He knows how to use the tax code, or at least his lawyers do, accountants do. And I tried to do the same. This is my 2019 taxes. And I really want to highlight that I am not a CPA, but I am trying to learn as much as possible around how to apply everything I've learned. And I've only really started learning most of this stuff by talking to other people who make a lot more money than me in real estate and pay zero in taxes. And that's what I've been doing. And I've been applying essentially everything that I've talked about to reduce my taxable income. So left a little bit of time for questions.
That's crazy. That screenshot of me. We don't have any more questions in here. See if anyone else has any questions, feel free to put it in the chat. I think we got quite a bit. Lots on OZs. I think that was a really good distinction when you talked about the cap gains rate, the 10% actually being on your cap cost basis.
Yeah.
Actually, it was a little unclear to me.
Not a 10-point reduction.
Mm-hmm.
Would be better, of course. And I think some people have asked me in the past whether if capital gains rates change in the future. I'm not 100% sure about that. I have asked many tax attorneys; they're not 100% sure. The IRS is often very murky in terms of clarifying things. So you do have 180 days from when you sell those stocks to invest in an opportunity zone fund, qualified opportunity zone fund. So it doesn't necessarily have the same tax year. If you sold it in December, you have 180 days from December. And if you sold it in December, you likely have a lot of capital gains that you made, and you don't want to pay it, but what if you invested those gains in May after the tax filing? Well, what I would do is extend your taxes, extend your tax filing, extend it to July, and then file your taxes in July with the with a form that would highlight the fact that you made $100,000 capital gains, and then you invested $100,000 from the December gain of 2020 into an opportunity zone in 2021. So that still apply. If you miss that window for some reason, if you don't plan ahead, you can always file an amendment and just apply it on your previous taxes.
All right, we have a question. Are there ways to make passive losses active without a spouse?
There are different types of losses that are already innately active. So for that question, not really. You can invest in oil and gas as another tax favorable industry. That's why a lot of people are in real estate and oil and gas. Drilling, intangible drilling credits essentially is a write-off against your active income. So you don't have to do any of this fancy stuff. You can just write it off. It's great. And this land conservation easement, I don't want to go into that, but just definitely Google it.
We have a question. Can you expand on leasing a rental to an LLC and have the LLC run an Airbnb? Wouldn't you just be transferring the active income responsibility to the LLC? For example, the LLC would then be the entity to have to pay for local transient occupancy taxes, right?
Yeah, so you would still have to pay all those taxes. It's just more about transforming active income to passive income, if that's your certain client. Active income for renting properties is considered anything less than 30 days. So if you have a Airbnb or Craigslist rental that rents for 31 days, it's now considered long-term, a long-term rental, and long-term rental is considered passive income. So it's really about having an LLC that rents to your Airbnb company at a 1-year lease that was essentially net neutral, hopefully, your Airbnb gains, and then essentially just shift it from active to passive.
Okay. What are some best practices and typical responsibilities and duties that are looked favorably by the IRS as qualifying for real estate professional? For example, 750 hours.
The IRS is all about narrative building. If you can have your spouse potentially take a Keller Williams course or become a agent and do a few showings, never sell anything, doesn't matter. Those qualify. It just creates a perception that that person is in real estate. Owning property helps as well, self-managing them or saying you manage it. In fact, if you own property, you could actually pay your somebody up to 25% of your revenue. That's maybe a little aggressive. 20% is around right. Essentially, then just neutralize any renter income. So there's a lot of ways. That's really income shifting at that point. Right? You're shifting income. You're giving it to somebody else who has a potentially lower income bracket. Potentially your kids, although probably 14 and above would probably even be more appropriate.
Okay, and then two more last questions, I think. One is that someone wants to know if they can see the snippet of your Schedule E.
There you go.
And then,
I don't have a Schedule E, I'm sorry.
no. And then lastly, someone wants to know if you're available for consult or advice.
I love talking about real estate and taxes. I'll share my info here.
Cool. And I think that was it. Thank you so much, Eng. I mean, I personally thought that was really informative. I hope everyone here also thought so as well. And this is Eng's contact information. I'm also available. I'm still at Apple, still W2 employee here. So you can find me on Slack, find me in AD, anywhere else. Feel free to ping me. Or if you lose Eng's information, you can also ping me to get his.